Okay, so good evening, class. I want to welcome you again to another class on corporate reporting with equity professionals. My name remains Wasil, and today we are going to continue from where we stopped last week. Remember that we already started out with financial instrument last week, and I hope to finish it today. So firstly, when we talked about financial instrument last week, I told you that when we mentioned financial instruments, what we went to learn about is majorly two things. I said a is majorly a debt instrument as well as an equity instrument. That's majorly what financial instrument revolves around as far as this standard is actually concerned. And looking at these financial instruments, we said we're going to be using two major standards to address it. The first of which was IAS 32. IAS 32 helped us to understand certain key definitions about financial instruments. And today, we're going to round up on that, looking at compound financial instruments. And also is IFRS 9. IFRS 9 basically deals with recognition, derecognition, measurement, as well as impairment of financial instruments. Hopefully, we're going to round up on this today. And there is IFRS 7 that deal with financial instrument disclosures. I told you we're not going to look at this already, but we'll just look at disclosures generally pertaining to financial instruments. Then looking at financial instrument last week, we jumped into the definition of financial instrument, and we said that it's a contract that gives rise to financial assets of one entity and financial liability or equity instrument of another entity. So we said that for a financial instrument to exist, there has to be a contract, and this contract would give rise to financial assets of one entity and financial liability or equity instrument of another entity. All that must be present for us to have a financial instrument arrangement. We looked at several examples to understand what a financial asset is, what a financial liability is, and what an equity instrument is. And I kind of kept it very simple and straightforward at a very high level for you guys, just to understand and take home the core point first. You see, for financial assets, I majorly zeroed in on saying that financial asset is cash or investment in equity or investment in shares when you buy shares in another company, or a contractual right to receive cash. Okay, and you will see that from here, I just ignore this other part of the definition just for simplicity for you, because it's not even only cash you can receive. It could be some other financial asset as well, but we didn't even get there. And because most of your questions don't even go there. And there are even some other areas that has to do with exchange of financial assets and financial liabilities with another entity under conditions that are potentially favorable. We didn't get to that. Our emphasis last week was that a contractual right to receive cash, so which we call debts. And you have right to receive cash. And we looked at to clarify that. Financial liability, we also stopped at contractual obligation to deliver cash. That was our emphasis last week. And also, I made you understand that physical assets like inventories, property, plant, and equipment, and even intangible assets are not financial assets, basically because these assets create an opportunity to generate cash. Okay, they don't give you the right to receive cash. And also, whenever you are expecting that, whenever what you're expected to deliver, what you're expected to deliver, if it is goods or services, that can not be a financial liability, right? When what you're expected to deliver is goods or services, that is not a financial liability, because for a financial liability to arise, the obligation must be to deliver cash. The same thing as when what you are expecting to receive is goods or services. We said that cannot also be financial asset, because for it to be a financial asset, what you're expecting to receive must be cash, right? So we use that to explain basically the the key elements around financial instruments. And we also place emphasis on taxes, that tax liability is not a financial liability, even though you have an obligation to deliver cash, but it is not contractual in nature. For that reason, it cannot be a financial liability. And we and also emphasize that when we talk about equity instruments, there has to be like a company. You have a company, the share capital of that company is equity instrument of that company. So whenever you want to say, okay, an entity has an equity, just know that that is the share capital of that entity. So we use that to understand the financial instrument ecosystem. And we even went further to look at some examples, which I ensured almost all of you participated by calling you out one by one to attempt most of these questions. So we didn't stop there. We moved on to recognition and derecognition of financial instruments. We said that before you can recognize financial instruments, he said the entity must become a party to the contract. Whenever an entity becomes a party to a contract, then you can recognize that financial instrument in your books. So for me to say financial instruments, that means it encompasses all those three elements of financial instruments, which is financial assets, financial liability, and equity. So you can recognize any of those three when you become a party to the contract. And you see, you become a party to this contract either when you have signed that contract, you have signed an agreement, or you have made a commitment, you have paid money, right? Because in most instances, when you want to enter into a financial instrument contract, you might not necessarily be signing a physical agreement. It could just be a commitment. Like probably you want to buy shares now. You could just send money to your broker, oh yeah, buy these shares. Probably you want to sell goods to someone. It might just be a phone call transaction that, okay, deliver the goods. And so it depends on whether you're signing a contract or whether you're making commitments. But the important thing here is you can recognize financial instruments in your books when you become a party to a contract. Also, they could be derecognized. First, we talked about the recognition of financial assets, and we said you can recognize a financial asset when your right to the cash flow has expired. Of course, this is what financial asset is, contractual right to receive cash, right? So when that right has expired, you can derecognize, move that financial asset from your books. Alternatively, if it's in the case of where you have bought shares, if your acquisition of shares was what gave rise to you having a financial asset, then you would recognize it when you have transferred substantially all the risk and reward of ownership of that financial asset. To keep it simple, is when there is an unconditional sale of that financial asset. when you have sold that financial asset, then derecognize it from your books because it's a representation of transfer of substantially all risk and reward when you have sold it. Alternatively, it could be a conditional sale. That is, where you sell a financial asset, but you still want to buy it back. That is, there's an option to repurchase, but it is actually a sale and a transfer of risk and reward if the price at which you are going to buy it back is at its fair value. It has to be at its fair value. Okay, so if you sell and you have an option to purchase at fair value, that's also synonymous to that, okay, you have transferred the risk and reward. So we can recognize that financial asset from our books on that basis. Then we went on to financial liability, and we said you can recognize the financial liability when the liability or the obligation is extinguished. And extinguished means that when the obligation is discharged, it's cancelled, or expires. Okay? Discharge is synonymous to settled, and cancelled is like, okay, the guy maybe he forgive you the loan, or for whatever reason it was terminated or it has expired, usually as a result of time. So I also made emphasis on when it comes to the recognition, there are other areas or other events that could result in the recognition of financial liability, like when there is an exchange of one financial liability with another, that could result in the recognition of the original or old one and recognition of a new one, exchange. Or it could be as a result of substantial modification of the terms of the existing financial liability. And a modification is substantial where is only substantial. And again, I explained to you that when I say modification, it means that probably you have changed the terms of the loan, like the life of the loan. I mean, over the period over which you're supposed to pay back, the interest you're supposed to pay, and probably even your outstanding interest, you're able to negotiate it slower. So whatever variable that you're able to negotiate or bring down, that's modification. So it is substantial where by the time you calculate the PV of the entire cash flow related to the original and the new one, right? If the difference is 10%, then that modification is substantial. When a modification is substantial, it means it's as good as you have to recognize that original financial liability, because that modification is as good as creating a new financial liability. So we need to recognize a new one, right? So, and finally, I mentioned that, you see, whenever you recognize a financial liability, I mean, it usually will result into you have to settle somebody, you have to pay. So if there is now a difference between the book value or the carrying amount of that liability and how much you settle, that difference must be recognized either as a loss or a profit, depending on how much you settled, right? If you settled for less, I mean, you settle 10 naira and your book value is saying what you owe is 12 naira. That's a gain. That would be a gain on settlements like that. So these are just other areas that I just actually brought in that ICANN has not really tested so far. So majorly, the key thing here is that a financial liability is extinguished, is recognized when it is extinguished, that is discharged or expired. We went on to measurement of financial instruments. So we picked them one by one. I picked financial asset, and I guess I finished it, but yeah, there are some things I did not touch. So for financial assets, I told you that there are three items that can give rise to financial asset from my explanation of last week. is either cash or investment in shares. That is, you bought shares of another company, or contractual right to receive cash, which we summarize to be debt instruments when you lend somebody else money. So we pick them one by one. That, okay, when we are talking about measurement of financial assets, that means these three elements needs to be looked at. So generally, cash, how do you measure cash? There's no other way to measure cash than the cash, right? So cash is cash. That is how you measure it for that aspect of financial asset. The second is equity investment in shares. How do you then measure that? I mentioned that. You see, when we talk about measurement, the first thing you need to think about is the initial measurement, which is the measurement at the date of the transaction. And initial measurement for almost all financial assets is straightforward and simple in the sense that it's usually measured at how much you have invested. So if you bought shares, if you invest in shares, the amount you paid ultimately will represent the initial measurement, and we call that transaction price. So all financial assets, look at the way I wrote it here, all financial assets are initially measured at transaction price. That is the amount that was invested or the price that was paid. Then, still on equity investment anyways. So at the end of the year, in fact, before the end of the year, at the date of acquisition, I told you last week that we need to ascertain the intention for buying these shares or for investing in this equity. And that led us to classification. We said that is either you are buying these shares for short term, for trading. That's okay, whenever you need money, you will sell, or for the long term. You see, to put numeric value to determine what is short and what is long is not actually something that was so specified in the standard. But the idea here is that if you have the intention that you will sell these shares whenever you need money, whether in the next 1, 2, 3, 4, 5, 6, 7, 8, or even 10 years, that is short term. When you have the intention that you will sell, you see, when we say long term, what we mean is that you are not selling. You are not selling. You don't want to sell. You want to be part of this company till you want to see the end of this company. You want to be with this company almost to forever. That's what we mean by for the long term. All you want is just to be getting returns. You don't have any intention of selling at any point in time. So that's long term. And I told you that when you have bought these shares for the short term, then you are going to classify it at fair value through profit or loss. If you have bought it for the short term, you are going to classify it at fair value through other comprehensive income. So those are the two classifications for equity investments, that part of financial assets: fair value through profit or loss and fair value through OCI. You see, this classification is done at the date of acquisition, at the date that you bought these shares. You need to know. And I explained all of this to you last week. Then all this is happening at the beginning. So what happens at the end of the year? You see, at the end of the year, we call that subsequent measurement. I told you that the same way you have classified these equity investments is exactly how you're going to measure it at the end of the year, which is either at fair value through P&L or at fair value through OCI. And I told you last week that if you had classified it at fair value through P&L, that means you must measure it at fair value through P&L. at the end of the year. If you had classified it at fair value through OCI, that means you must measure it at fair value through OCI. And I told you that the difference between the two is just the fact that when there are changes in fair value, for fair value through P&L, that change in fair value will be recognized to P&L. But if the way you are measuring it is fair value through OCI, that means when there is changes in fair value, that change in fair value will go to fair value through OCI. And you agree with me that share price or shares generally, their prices fluctuate. It's not static, right? So if you bought shares in the middle of the year, and at the end of the year, the price has gone up, so you'll have made a gain. So if the way you have chosen to measure it is at fair value through P&L, that means that gain will go to P&L. If the way you have chosen to measure it is at fair value through OCI, that means that gain will go to OCI. That is what we are talking about here. Okay, and that was it for equity investments that I explained to you last week. And also, I think I mentioned that when you buy shares, you would usually require a stockbroker to help you buy it, and you will have actually paid that stockbroker. So it's not usually free. You will have paid that stockbroker. So if you bought shares for 50,000 naira, right? Ordinarily, you debit your financial assets at either fair value through P&L or fair value through OCI and credit bank. So the agency fee you paid to stockbroker, let's say it's 5,000 naira. Of course, you credit bank. Where do you debit? Are you debiting financial assets or P&L? Is there anybody that can try? You bought shares, right? 50,000 for 50K. That means that is a financial asset. You credit bank, debit your financial assets. So if you financial asset at fair value through P&L or at fair value through OCI, depending on how you have classified it. So my question is that if you had used a stockbroker to buy that shares and you pay that stockbroker 5,000 naira, so where would that, of course, since you are paying your credit bank, where do you debit? I said, are you adding it to that 50,000 in financial asset account, or you are taking it to P&L? That was my question.
It will be expensed to P&L.
You are taking it to P&L. Okay,
Yes.
so you're partially correct. I think that was the same thing Ayodele Dairo said also. You're partially correct. So that means you're also wrong at the same time. So it depends on how you have classified that financial assets at the date of acquisition. So remember, you can either classify it at fair value through P&L if you are holding it for short term, or at fair value through OCI if you are holding it for the long term. So if the way you have classified it is at fair value through P&L, that transaction cost will be recognized to P&L. You're not going to debit financial assets, you're actually going to debit P&L. But if you had classified it at fair value through OCI, that transaction cost, or that money you pay to that stockbroker will be capitalized. That is, it's added to that 50,000. It will be added or debited to that financial asset. So please note that the treatment of that transaction cost depends on the classification of that financial asset. Okay. Last week, I'm still revising. So last week, we also looked at debt instruments, which is also investment in debt instruments, which is the last part of financial asset, right? We are still under financial asset. So for debt instrument also, which is basically when you lend somebody money through loans or bonds, whatever instrument that you use to lend someone money. And again, initially, all financial assets are measured at transaction price. So when you lend somebody money, you see at the date of the transaction, whatever amount you lend the person is going to be what you're going to recognize as the value of that financial asset. So if you're having like the government just issued out some foreign bonds or dollar bonds. So if you had bought any of it, so just get how much but even though now it has to be in dollars, just get how much you had invested. That's how much you're going to recognize in your books at the date of the transaction, how much you had invested, right? So we have cleared that. Now, again, I told you that immediately you need to classify that financial assets for the case of debts. And I told you that the basis of classifying in this case is looking at your business model. When I say business model is, okay, how do you want to make money from this lending that you have done? And I told you there are two ways. Number one is solely to collect interest and principal. And number two is, of course, collecting interest and principal is a permanent feature, unless otherwise stated, is an assumed feature of debt, interest and your principal. However, you can also have the intention of selling. Like these bonds that Nigerian government just issued is going to be traded on the stock exchange, right? It will be publicly traded on the market, right? So you can actually sell and buy in the secondary market. If you are unable to participate now, you can trade it. So if you have intention of also selling, that's another way of making money, or that could be your business model. So it's either one of these two. And the second basis of this classification is contractual cash flow, which simply means that there has to be a contract that would say that, okay, you collect interest and principal. This is also like a permanent feature of all debt instruments. So you'll find the examiner majorly focusing on the business model for us. So having understood that, we then went on to that, okay, there are three ways in which you can classify these debt instruments. The first one we said is amortized cost. The second one is fair value through OCI. The third is fair value through P&L. Okay, I think I'm back. My internet went off very briefly, so let me continue. So I was saying that uh, the difference between this classification and the one you have learned earlier for equity is this amortized cost. I think that's the new one here, amortized cost. So now, what would determine where how you're going to classify? Now, for the first one, you will classify this investment in debt at amortized cost. If your business model is solely to collect interest and principal, meaning that you don't have any intention of selling, you want to collect just interest and you collect back your principal at maturity. That's your model. That's your model. Then you just classify it at amortized cost. And of course, contractual cash flow, which is a permanent feature, so which says that there should be a contract that will state that, okay, you collect interest and principal. That's amortized cost. The second one, which is fair value through OCI, this one, your business model has to be that, okay, you collect interest and principal, that is contractual cash flow, and you also have intention of selling. So whenever there is intention to sell a debt instrument, it is going to be classified at fair value through OCI. It will be classified at fair value through OCI because that's the major difference between amortized cost and fair value through OCI. It's just that for fair value through OCI, you can also sell. As that it's part of your business model, how you want to make money from this investment. And of course, contractual cash flow which is a permanent feature that, okay, there has to be a contract that will state that, okay, oh, you collect interest and principal, stuff like that. And the third one, which is fair value through POL, this one, there's no basis. This one is a default classification. In fact, see, if you look at this, my first sentence, financial assets should be measured at fair value through POL unless they are measured at amortized cost or fair value through OCI. So primarily, these debt instruments should be measured at fair value through P&L. Is a default classification. Default. So if you don't know, if you don't want to bother yourself about business model and whatever, just classify it at fair value through P&L, and that is it. That is it. Okay. Now, those are the three classifications, and similar to equity, the same way you have classified is exactly how you're going to measure it at the end of the year. The same way. There's no difference. The same way you have classified is how you're going to measure it. So I can summarily say that financial assets for debt investments are classified and measured at amortized cost, fair value through OCI, and fair value through PRL. Now, let's go to the key parts very quickly. Very quickly. So, when we say that amortized cost, what does amortized cost mean? What does it mean? You see, fair value, whether fair value through P&L, fair value through OCI, those ones are very straightforward because those ones are speaking about the market value, market price. No examiner will ask you to determine that. They will give it to you. It will always be given. Market price. Nobody can, it's anything market generated. So that one is not a problem. So now, what you need to quickly understand in the next 10 minutes is how to derive amortized cost. Amortized cost. And remember, for you to classify a debt instrument as amortized cost, your business model must be that you want to collect interest and just principal. You don't have any intention of selling. You are going to stay there. If the money you have lent the person is for 5 years, yes, you're going to be there for 5 years. Collect your interest every year, then exit at maturity. That's it. So I will use two examples to demonstrate how to determine amortized cost to you. Number one, the first example, which is a straightforward one. So there's a 10 million naira, 5 million, 5% loan. Okay. So this 10 million will be repayable at the end of 3 years. Okay. So this is the most common and the most straightforward structure you have for a loan or a bond or a debenture, anything. Like even the one the government is doing right now, this foreign one or this dollar denominated bond, it's just buy the minimum they say you can buy is $10,000, and each unit I think is 1,000 units, like that, and the rate is around 9 point something percent, 9.9 or 9.3 or thereabout. So that's just it. So, and when you have a loan like this, and of course at maturity they will pay you back your whatever it is you have invested, which is the 10 million. So this is so straightforward in the sense that all you just need to recognize, in your books is one, the fact that you have invested 10 million naira. Just credit bank, debit financial assets. And if you have the intention of staying to maturity, you will describe that financial asset as financial asset at amortized cost. That's what you will do at the date of the transaction. And at the end of each year, recognize the interest. the 5% interest. 5% times 10 million. So all the efforts that you'll be making at the end of each year in terms of accounting is just recognizing 500,000 per year for 3 years. And how do you recognize that 500,000 per year? You credit bank. No, not credit bank. You're actually receiving interest. You debit bank because money is coming in. Where do you think you credit, class, for this interest of 500,000 every year? Anybody? Anyone?
I'm guessing POL.
That's correct. Yeah, that's very correct. So you credit POL for interest majorly. So year one, debit, you collect your money, credit it to P&L as a finance income. It's an income to you now. So year two, debit, bank, credit. Year three, debit, bank, like that. So at the end of year three, when they give you your 10 million, how do you then recognize that financial asset from your books? Because one of the criteria for the recognition is when your right to cash flow has expired. So after 3 years, how do you recognize it? Anybody? What will be the entry you pass? Anybody? Okay, no time. So
You debit cash and credit loan receivable.
thank you very much. You debit bank or cash because you are collecting your money back, and you credit the financial asset. And that's it. It goes. And that is how straightforward this one is. So now, yeah. So that means that for a simple instrument like this, your financial assets in year one is going to be 10 million. And that's the amortized cost. Your financial assets in year two is going to be 10 million. And that's the amortized cost. Your financial assets in year three will be 10 million. It's not changing. It's just 10 million. And your interest you are collecting every year, 500,000 P&L. That's it. Okay. Now let's go to another one. So now, if you have another one like this, the same 10 million naira loan, okay, you collected it 2001, okay, you invested in a 10 million naira loan in 2001, meaning you lent some of the money, and you are collecting interest of 5% every year. But at maturity, they will give you 11 million back at the end of the 3 years, which is 31st December 2003. Okay, so this is different from that first one. So you invested 10 million. If I want to treat this similar to how I've explained it to you initially, you credit bank, you debit your financial asset. You credit bank, you debit your financial asset. That's for that 10 million. At the end of year one, you book your interests. Let's assume that you receive your interest at the end of year one. So that means you're going to debit bank, and you credit what do you credit? You credit P&L with 500,000. So you do that in year two, you do that in year three. However, at maturity, what you are collecting back is 11 million. Who can tell me? How do you recognize this 11 million? Anybody? This 11 million you are collecting back is just the same thing as the first one when you collected back 10 million that you invested. But this one, you are not collecting 10 million, you are collecting an extra 1 million, you're collecting back 11 million. So how do you recognize this 11 million that you're collecting back? Of course, you're going to debit bank of 11 million. If you credit your financial assets with 11 million, don't forget what is in your financial asset is 10 million.
10 million.
So if you credit it with 11, something is wrong. Abi, so that's a totally wrong way to go about it. It will not work.
The 1 million is a premium.
Okay, thank you very much. So somebody said the 1 million is a premium. Okay. And I think somebody wrote that, okay, Ayo, he said we'll credit that 1 million to P&L. Okay, that's extremely logical, but that's against accrual concept. That's against accrual concept.
It has to be
Because
spread out.
exactly. You cannot wait till the end of the third year before you recognize that 1 million. You need to spread it over the 3 years. You need to recognize it over the 3 years. And that's the only thing extra here. And it's logical. So that goes to show that what you're recognizing to P&L every year is not going to be this 5% alone. It's not going to be this 5% alone. In addition to this 5%, there will be an extra amount, which is that 1 million that you're spreading over 3 years, that you need to also add. So the examiner will help us. So in addition to this 5%, which is a fixed interest every year, the examiner will now give you an effective interest. You see, whenever the examiner gives you an effective interest, that means that what you are collecting as profit or interest from this arrangement is beyond that fixed interest. You are collecting something extra. In this case now, extra 1 million, which they are spreading over 3 years. Now, in practice, there are ways with which we calculate this effective interest rate. In the exam, they will give it to you. In the exam, in this case now, because of this type of cash flow, if you structure this cash flow on Excel, where you put year 1, outflow 10 million, year 2, inflow 500, that 5% of 10 million, that's year 1 inflow 500, year 2 inflow 500, year 3 inflow 500, then the same year 3 inflow 11 million. If you do equal to EIRR and you highlight the entire cash flow, it's going to give you 8.08%. Okay, it will give 8.08%. So, but in the exam, they will give it to you. But what I just need you to understand is this, okay? So that you understand this and understand it finally. You see, this 8.08% is just this 5%. This 5% that you recognize to P&L normally, plus that 1 million that you spread over 3 years. So Excel or modeling has helped us to ascertain that as around 3.08% per annum. So that is what we are using to share that extra 1 million over the 3 years. So they use effective interest rate to achieve that. So that means what actually goes to our P&L every year is 8.08% and not 5%. I hope that is clear. I hope that is clear. And this is only coming up where issues like this arise, that in addition to this 5%, we are also earning something extra. Like in this case, we're earning extra 1 million. So that takes us to amortization schedule. So it's when they give us effective interest, that's when you have to do an amortization schedule. So in this case now, in year 1, which is the beginning of the year, we're going to recognize 10 million, right? The effective interest is 8.08% because that's what actually goes to POL. That's 8.08% of 10 million. That's 808. And don't forget that what we will receive is not these 808. This 8.08% is just coming in to help us determine our actual income in year 1. That is the 5% and that extra premium, right? But what you actually receive in cash, what they will pay you as interest is 5%, right? So by the time you remove that, so that means you invested 10,000, you earn extra 800. Now you have received 500. So by the time you do 10,000 plus 808 minus 500, that means you're expecting 10,308, which you're going to carry to year 2. Okay, so then you're carrying it to year 2. So opening year 2. So you apply the same 8.08% on that 10,308. That gives you 833. Then don't forget what you are receiving is still 5%. This 5% is always on the principal amount. So 5% is still 500 every year. So the balance, your balance is now 10,641. You see, this balance are what they call amortized costs, like I've told you earlier. So this 10,641, again, you carry it to the next year. Your interest 8.08%, 859. You receive 500. You see that the balance is exactly 11,000, which is exactly how much you are getting at maturity. And that is it. So but when they now pay you this 11,000, then you can easily debit bank and credit financial asset, because the balance in your financial asset account is going to be 11,000. Now, when you look at it, I did some explanation here, a lot of it. So let me just summarize it for you. You see, this 808, it's not something you are receiving in cash, at least. It's just the income. So this 808, you credit P&L, you actually debit the financial assets with this 808, right? You credit P&L as an income, you debit your financial assets. Or you can debit an interest receivable if you want, but it's just easier. Debit financial assets, easy. When you now collect the money, the interest, this 500 naira, you now debit bank. You can then credit that financial asset. Then the balance in your financial asset is this. So you do that in year 2, year 3. So balance comes to 11. And they will eventually pay you your 11,000. You debit bank, you credit financial asset. Now, just to show you that this 8.08% is actually our income over the 3 years. Let me go back to that question where I said you invested 10 million. They are giving you 5% every year, and you collect back 11 million. If you look at this very closely, you are making 2 categories of income. Number 1 is the interest, 5% per annum. Number 2 is the premium, which is 11,000 minus 11 million minus 10 million, which is 1 million. So 2 income. If I sum those incomes together over 3 years, like this 5% per annum now, which is 500,000 every year, for 3 years is 1.5. If I add that to that 1 million premium, that means my total income over 3 years is 2.5. You see, if you add 808 plus 833 plus 859, it should give you 2005. If there's any difference, maybe 1 naira or 2 naira or thereabout, it should give you 2005, because this 8.08% is what is helping you spread that 2.5 over 3 years. Okay. I hope you had pressed and saw that it actually gave you 2.5. Okay, so amortized cost is really not more than this. So we'll look at questions. It's not going to be more than this, right? So what you just need to understand is that when they give you effective interest rates, they might give you fixed interest, and they can even tell you that this interest is 0. This particular one is 0. They can, whatever it is, just know that if they give you a nominal interest or a fixed interest, that is always calculated on the principal amount, and it's always fixed every year. It's fixed. It doesn't change year 1, year 2. You receive the same amount. In fact, in reality, they pay you upfront. in most debt instrument that you invest in, they will pay you upfront, collect your money like one off. Okay. So that's that for that. Again, let me quickly tell you. You see, for the other two, which is fair value through OCI and fair value through POL, those ones you still have to do amortized costs. You always do this in any collection of debts, especially when there is effective and nominal interest. You always do this. So, but if the examiner now say that, okay, this guy measures it at fair value through OCI, that means that the examiner is ready to give you the fair value at the end of each year. Yes. So that means after you have gotten this now in year one, the examiner can then tell you that, okay, the fair value in year one is 10.5. That means you need to update this from 10,308 to 10.5. That will be treated as a change in fair value. So if your method is fair value through OCI, that means that change will go to OCI. If it's fair value through POL, that means that change will go to POL. But you see, this table is something you will always do. So this is the most important thing. So amortized cost, fair value through OCI, fair value through POL. It's no more than this. And that is it about financial assets. That's financial asset for you. So this is the note I'm showing you. So financial assets, you are done with financial asset. Now, you see, for financial liabilities, that is when you are the one that borrowed money. You borrowed money. So when you borrow money, again, financial liability is always or will be held at amortized cost. Let me just shorten it like that to you. You see, the way I've calculated amortized costs for financial assets is the same way for financial liability. Just that the only thing that will change is that this one is a liability now. So the interest now is not, you are not the one receiving it, you are the one paying. That is the only difference here. That is the only difference here. And again, if you have to incur any costs, so before when you were investing, it will be recognized as the net proceeds, meaning you need to remove that cost. Maybe you paid a broker. You have to remove it. So for financial liability is not really about whether you are using fair value to OCI or fair value. This one is always at amortized cost. And when you are using amortized cost, the transaction cost will be deducted. Will be deducted from the money you have borrowed. From the money you have borrowed. So let me just do an example with this one. It's just similar to what I've explained. I just want to add something else. So now let's say WASU PLC, I issued 10 million. When I say I issued, that means I'm the one borrowing money. So I'm supposed to pay 5% every year. But I also incurred 200,000 issue costs. Right? So the loan note is repayable at a premium of 1 million. That means that when I'm paying back at maturity, I will be paying back 11 million. That's what they mean by a premium of 1 million. So just similar to that example I've given you now. So just like I've taught you before, in this case now, if I want to summarize it, you see, the cost of this borrowing to me is one, I'm paying 5% every year, which is 5% on 10 million, which is 500,000 every year. Two, I'm paying at a premium of 1 million. That's making 2.5. And three, I'm incurring an issue cost of 200. That's the cost. As it is, because my cost now is just beyond this 5%. I will need to spread those costs over 3 years, just like I've taught you already. So the examiner will give you an effective interest rate that will help us to do that. So they will give you 8.85%. They'll give you 8.85%. So when you have that, doing your this thing is straightforward. So in year one now, what you recognize is 98, not 8,000. 98, because that's the net proceeds. 98. The effective interest is going to be 8.85% of 98. That's 867. But the interest you will actually pay is 5% on 10,000. This is very practical because the person that gave you money will want to collect interest on the money he lent you. He will not is none of his business that you have to incur issue cost. You are going to be paying 5% on what he lent you, which is 10 million. So that's why this one remains 500 every year. Okay. So why the effective interest? Why this one is always calculated on 10 million fixed every year? This effective interest is calculated on the opening balances. On the opening balances. That's why they vary like that. And again, if you add this 867, 900 plus 933, if you add these three together, should give you that 27. That 27, which is this 5% per annum, 15 plus 1,000,025 plus 200, 27. We have spread it over 3 years using this effective interest, so it automatically gives you 27. And just like I've explained under the financial assets, this 867, by the time you are crediting your financial liability, you are going to be debiting P&L as a finance cost. The same thing you do in year 2, the same thing you do in year 3. You are crediting the financial liability, you are debiting your finance cost in P&L. But this amount that you are actually paying, that one you credit bank and you debit the financial liability. While these ones are the amortized costs, of course, which we expect to equal the maturity amount, which you are going to pay. And when you pay this, you just credit bank, you debit the financial liability to recognize it from your books. You use that to recognize it from your books. Okay, so that is all for financial liabilities. That is all for financial liabilities. Then, still on measurement of financial instruments, there is equity instruments. So how do you measure equity instruments? Like I told you, equity is the share capital of a company. And in Nigeria, the way we measure share capital is through nominal value. So equity is measured at nominal value. So, and in real life, you get nominal value from your CAC documents. By the time you multiply that nominal value by the number of shares that you have in issue, you get what goes to the share capital account. So, not to mention that your share price can be higher than that. If your share price is higher than your nominal value, the excess actually goes to share premium. So that is all for equity also. Any questions? Okay. That was long. That took us well over 40 minutes. Longer than expected. Okay, so there are some questions here. Let's just look at a few of them together. So it says here that on 4th January 2010, Number purchased a debenture for 2,000. The debt instrument is due to mature on 31st December 2014. The instrument has a principal amount of 25, and the instrument carry a fixed interest at 4.72% that is paid annually. How should Number account for the debt instrument over its 5-year term? Okay, so Number purchased the debenture. So when they say he purchased the debenture, that means what you're saying is that this guy has invested. This guy lent somebody money. So he has a financial asset. So the debt is due to mature in 2014. The principal amount is 25. The fixed interest is 4.72. The effective interest rate is 10%. How should they account for it over 5 years? Okay. So in year one, which is 2010, you recognize it at the transaction price, which is the amount you invested. The interest receivable, which is the effective interest, given as 10%. So it's 10% of 2,000. But the interest you actually received, which is 4.72%, is going to be 118. This 118 is not 4.72% on 2,000, though. It's actually 4.72% on the principal amount, 25. So when I can ask this question, almost all students failed it, except those that have seen this question before, or those that read critically. Those ones got it, but majority of students failed because they just felt that it should be on this, whereas the fixed interest for the annual interest is always on the principal amount. So this 4.72% is on 25, which is 118. So if you accumulate this, it gives you 2082. So you carry it forward. You do the same thing over and over again for year 2, 3, 4, and 5. The balance you get is 25, right? Then, which will be settled at maturity. Then there are other questions here that are quite straightforward. If you look at this other one, in January 2018, Latino acquires shares. He invested in shares and he wants to hold it for the long term. The cost is 400, right? So that's how much is invested. So at the end of the year, it's now 475. So this one is very straightforward. So they are just asking, how do we recognize that? So at the beginning of the year, recognize this 400. At the end of the year, recognize it 475. The difference of 75 will go to OCI because this guy has the intention of holding it for the long term. And since this investment in shares, that means he will classify it at fair value through OCI and he will measure it at fair value through OCI. So any changes in fair value goes to OCI. So that's this one. Now, this is another very simple one also. So almost similar. So I won't even go over this one. It's very similar to these other ones. So just trying to understand, making sure you understand what goes to OCI. In fact, let me intentionally look at this one. So this guy purchased 40,000 shares. The share price is 2 naira. So that means we will have invested 80,000, right? Transaction cost is 4.5. Okay, this is why I want to look at it because of this transaction cost, because I've taught you something about this. So at the end of the year, it's 3.5, and he received dividend also. Then as you should show the financial statements, if the shares were bought for trading, that means condition for fair value through OCI has not been met. So that means it will recognize it at fair value through PRL. And also condition for OCI has been met. So now, if you are using if you are using fair value through P&L, right? So number one, the financial asset at the end of the year, you recognize it at this price, this 3.50 kobo. That's 140,000 naira. The gain, because you have made a gain, because at the beginning of the year it was 2 naira, now it is 3.50 kobo. But that 150 kobo gain, because it's fair value through P&L, it goes to P&L. So this gain is going to P&L. And this transaction cost of 4.5, again, because it's fair value through P&L, I told you the transaction cost will be expensed. So it goes to P&L. Right? And of course, the dividend received goes to P&L because this guy is getting 20 kobo per shares. This guy is getting 20 kobo per shares. But if it is fair value through OCI, nothing changes in the statement of financial position, right? Except that I'm putting this, is still 40,000 times 3.5 because he's holding it for the long term. I just put it under non-current asset. But you see the gain will actually go to OCI. The gain will go to OCI. But how did I get the gain here now? I need to show you the workings. See, for fair value through OCI, initially, the transaction cost will have been added to the cost of investment. You capitalize the transaction cost, you don't expense it. So the initial cost here will have been 84,500, which is 80,000 plus 4.5. And at the end of the year, since the price is now 3.50 kobo, the value is 140,000. So the gain is 55,500. So that's why this gain to OCI is 55,500. So this one goes to PRL. So that's that. Now, this other question, this guy, he issued a bond. And when we say somebody issued, it means that he borrowed money. On 1st of January 2017, no interest is payable on the bond, but it will be redeemed on 31st December 2019 for 300,000. The effective interest rate is 3%. Calculate the P&L. Okay, so this one is quite straightforward. So this guy actually borrowed 251,889 at the beginning of the year. So you will pay 300,000 at maturity. So they gave us effective interest rates. They said no interest is payable. So what goes to P&L? I did an amortization schedule. So at the beginning, the value is 251,889. Since they told me that effective interest is 3%, so I charged 3% on 251,889. In this question, there is no annual interest, no fixed interest. So that means what goes to P&L is this. Even if there is fixed interest, it doesn't matter. What goes to P&L is the effective interest. So that's that for that question. Quite straightforward. And there's this other one, Wakeb. This guy also issued, so financial liability, but he also incurred issue cost of 200 naira. They said no interest, but it will be redeemed at a premium of this. Okay. The effective interest is 10%, 12%. What's the finance cost at the end of 2018? So again, in 2017, okay, we are going to measure this at the net proceeds, which is 600,000 minus the issue cost. Right? That's for financial liability. You would remove the issue cost. So that brings us to 599,800. The interest, the effective interest will be 12% or 599,800. So we don't have a fixed interest here. So this is 671776, which you carry forward. In year 2, it's 12% on the balance go forward. This is 8613. So the answer is 8613 because they're asking for the finance costs at the end of 2018, which is this one. So That's that. And there's this question that says that Debbie Limited issued a debt instrument with a coupon rate of 3.5% at par value of 6 million. The directly attributable cost of issue were 120,000. The debt instrument is repayable 2023 at a premium of 1.1. What's the total amount of finance cost associated with this debt instrument? Okay, so the total amount of finance costs here, number one is the coupon rate, which is the annual interest rate of 3.5% of the par value or the principal value of 6 million, which we are going to be paying every year from 2017 to 2023. That's 7 years. That's the annual interest, the fixed interest. So 3.5% per annum of 6 million for 7 years. That's the 1.4 million. Then the issue cost is also another finance cost that will spread over, so which is 120, and also the premium of 1.1. That gives us 2,690. Okay. Again, a lot of students will fail this because a lot of students will start doing amortization schedule like this. You can only do amortization schedule if the examiner asks you to calculate finance costs for a specific year. For a specific year, like this question here and this other one that we solved. This one is finance costs. What is the total amount of finance costs over the period? So if you use this schedule, it will not work for you because this question didn't even give us the effective interest rate. So they just gave us what constitutes everything, which is the nominal, the issue costs, and the premium. What constitutes everything is what they actually gave us. Okay. And there are some, before I go to convertible instruments, let's go to what I can have asked so far. Is this past question here? This for skills. Let me see this one. Okay. Okay. So there's this question in March 2020. What's happening? This class is so quiet. I know that it's not like, okay, let me assume that you're getting it. Can somebody read? The way this class is too quiet is giving me discomfort.
You're following.
Okay. Yeah, GD read. Read this 2020 question. March 2020.
You've taken it up. Okay. Abacom Bank is a microfinance bank. The bank, which has recently made the transition to FRS 9 financial instruments. The bank is working through the classification and measurement provisions under FRS and have requested your firm to provide some guidance. You are the senior consultant on the engagement, and the following notes were taken during the meeting you have just attended. Meeting notes. The bank has invested in debt instruments of the Federal Government of Nigeria, FGN bonds. The bank's strategy is to hold this instrument until maturity and receive the contractual cash flows solely principal and this interest accruing from this debt investment. The bank is known to sell some of these instruments prior to maturity. The last sale occurred about 5 years ago, and all instruments held since then have been held until their maturity dates. The sale of debt instruments that occurred 5 years ago amount to less than 2% of the bank's entire portfolio of debt investments. Directors of the bank do not have any accounting mismatch to consider. Required. Discuss briefly how the debt investments, FGN bonds, should be classified by the bank in accordance with IFRS 9.
Thank you. Thank you very much, Jide. Okay, I know it's 7 marks. I will teach you how to answer the question. But how should the bank classify this debt investment? Let me remind you, debt investment can either be classified as amortized costs if your business model is just to collect interest and principal at maturity, or it's classified at fair value through OCI if your business model is to collect interest and principal and also sell when the opportunity arises. And 3 is fair value through POL, which is a default classification. See, they mention something about accounting mismatch here. Okay, so mostly you might want to avoid accounting mismatch and use fair value to POL. And this will usually arise where if you're having a financial asset as well as you have a similar instrument as a financial liability too. So you might want to classify and measure them like the same way. So just to avoid mismatch in accounting might be one of the reasons why you would measure or classify at fair value through PRL. So this one is already telling us that no, this will not be classified at fair value through PRL. So that means this question, the answer is between amortized cost and fair value through OCI. So what's the answer here?
Fair value through OCI.
Why?
Because they want to resell. They want to sell some of the instruments before maturity.
No, they said they have sold before and they have not sold since 5 years ago. So they didn't say they want to sell. Ojo?
Okay, I'm guessing it's amortized now. I didn't read it. I thought they wanted to sell.
Okay. All right. So, I mean, good attempt. But this is 7 marks question. You are not going to get 7 marks by just telling them amortized cost or fair value to OCI. So the first thing you need to do for you to earn these 7 marks in a question like this, because this you will see by the time we start, of course, we have started going to this is a past question now. So the first thing you do is to state the principle of classification of a financial assets, not just financial assets now, the specific debt investment. You will explain it that, okay, debt investment are classified at either amortized costs, fair value through OCI, fair value through PL. They are classified at amortized costs, where the business model is that the entity wants to collect interest and principal. And there is also a contract that specifies that it will collect interest and principal. It is classified at fair value through OCI, where the business model is that the entity will collect interest and principal, as well as sell the financial assets if it has opportunity for an higher yield. And also there's a contract that specifies collection of interest and principal. Number 3 is fair value through PL. This is a default classification. And debt investment are usually classified at fair value through PL, where they are not classified at amortized costs or fair value through OCI. And they are also used to avoid accounting mismatch. You see, that will earn you almost 4 marks. Almost 4 marks. Now, we now go to the next paragraph and say that from the question, the strategy, the bank strategy is to hold these instruments, unto maturity and receive contractual cash flow. However, the bank is known to sell some of these instruments prior to maturity. And he has only sold 2%. However, since this entity has history of selling, they have sold before, that means they can sell again. The reason why they have not sold for the past 5 years is that they have not really seen an incentive to sell. I'm sure if they are offered a good rate, they will sell. So they can still sell. For that reason, they will they will classify the debt investment at fair value through OCI. You see, that is what will earn you these 7 marks. It's not just saying whether OCI, whether whatever. Even if you are right, you might not get more than 1 mark or 2 marks in the exam. You need to state the principle, then you would point the core elements in the case, then you then make conclusions. 7 marks for you. Okay, so
Claire, did you say it to be measured at amortized or at fair value through OCI now?
yeah, it will be classified at fair value through OCI because they have an history of selling. They have sold before, they could sell again if they are given proper incentives. So that's the basis. So, okay, fair value through OCI. All right. So there are some other questions here that one way or the other I've mentioned some of them before, which you can look at. There are a lot of questions here for you so far. So now, let me go to compound instruments or convertible instruments. Let me go to convertible instruments. So now, you have learned about recognition and measurement of financial instruments. However, there are certain instruments called compound instruments. So these compound instruments, they are typically convertible instruments. They are typically convertible instruments. And from the name convertible, it means that whoever holds it, okay, whoever invests in this type of instrument can either demand that he collects his principal amount or he converts it to shares. It's either we can request. So if I lend any of you money and the instrument we use is a convertible loan, what that means is that me that I give you money, I have the right to either demand for my principal at maturity or I convert my balance into shares. I'm the one that have the choice now. But for your exam, the examiner will not ask you questions on convertible instrument from the perspective of the investor. No, it's not. We're not going to consider me. For me, it will leave me. The focus is going to be on the issuer, the person that issued the instrument. That's basically what the exam will focus on. So for the issuer, you see, primarily, this is like a financial liability primarily, because the issuer primarily borrowed money, right? He borrowed money. Just that he is now giving an option to the investor to become a shareholder at maturity. Okay. So see, the challenge is this. The challenge is this for us. Since there's a possibility that this money I have borrowed could result in me issuing shares. So there's a possibility that I could issue shares, that I might not deliver cash at maturity. Therefore, at the date I borrowed money, I would have to separate that money I borrowed into liability and equity, just like I've taught you before under share-based payment, where there is a choice of settlement. This is very similar to that. Just the fact that I'm not sure, I don't know what the investor would decide to do. I don't know whether the guy will say he wants to collect back his principal or he wants to convert to shares. I don't know. So I would have to consider the possibility of the two together by recognizing a portion of that money I borrowed as liability and recognizing a portion as equity. And the same thing I taught you under equity is the same approach here. The debt component is what you are going to determine first. While the equity component will be the balancing figure. Just that the approach to determining it here is different from share-based payment. For share-based payment, you already know the number of shares, you know the value at each reporting date, you know the value at the date of issue and all of that. So, but for this one, it's quite different. So let's see how we can do that separation with this question here. Let's see how we can do that separation. So if you look at this question, it talks about Ferry Limited. It said they issued 4,000 convertible bonds at 1st of January 2021. The bonds have a 4-year term and are issued at par with a face value of 2,000 naira per bond, giving total proceeds of 8 million. Interest is payable annually in arrears at a nominal annual interest rate of 6%. Each bond is convertible at any time up to maturity into 250 ordinary shares. When the bonds are issued, the prevailing market rate of interest for similar monetary conversion options is 5.9%. What is the value of the equity component of the bond? Okay, now if you look at this question, Ferry Limited issued a convertible bond. That means it creates the normal challenge that there's a possibility that the investor might want to convert to shares. So you need to consider element of the two when you're recognizing these convertible bonds in the books. So these bonds is 4 years. He issued each of them at 2,000 naira per bond. So that means this guy is borrowing 2,000 times 4,000, which is 8 million, which they gave us here, 8 million proceeds. So the fixed interest is 6%, right? The market interest rate is 9%. And I can tell you for free that the reason why the market interest rate is higher is because this one have a conversion option. it is more attractive to investor. It's more attractive because it's safe. Is the risk has been reduced to a large extent in the sense that even if the issuer goes into financial distress, the investor can still get shares. Okay, it's different from these other ones without conversion option. If the issuer should go into financial distress, they will lose their money. So the risk inherent in there is higher. So they request an higher return. So that's why this market interest rate is higher than the nominal interest on these convertible bonds. So how do we get the equity component here? So the first thing is for us to get the debt component. To get the debt component, which is the financial liability, is for us to get what's the value of the financial liability today. And note that this I'm doing at the date I borrowed the money, which is 1st January 2001. Remember, I borrowed 8 million. I'm paying 6% per annum. So I just need to know that, okay, this 6% per annum that I'm paying every year, at this date, what's the present value? So since I'll be paying interest for 4 years, and if you do 6% of 8 million, it's 480,000. You need to get the present value of that. And the discount factor you are going to use has to be the market rate. You cannot use a negotiated rate. It has to be the market rate that we use to discount. Okay. So, and you're going to use an annuity formula. Since this is annual equal amount every year for 4 years, is there anybody that cannot determine this 3.240? If you cannot determine it, this is the formula. 1 minus 1 plus r raised to power minus n divided by r will give you 3.240. This is your native formula. Okay, so when you get 3.240, you multiply it by 480, gives you this. This is the present value today of this interest annually for 4 years. This is the present value. And also, you're also going to get the present value of the principal that you're going to pay at maturity as year 4, which is 8 million. So to get the present value of a future payment, you simply use the discounting formula, which is 1 plus r raised to power minus n. Of course, the minus n here is going to be 4. The r is 9%, of course. When you punch your calculator, it gives you 0.708. If you multiply it by 8 million, it gives you 5.6 million. If you add it to the 1.5, that will be 7.2 million. And this 7.2 million is the liability component. The equity becomes the balancing figure because the sales proceeds or the amount is borrowing is 8 million. And out of this 8 million, we have calculated the liability component to be 7.2 million. That means the equity component is 780. So this is the double entry at this date. You will debit bank with the amount is collecting. You will credit financial liability with 7.2 million. And you will credit equity with 780,000. 780,800. And that's how you determine the equity component. Let's solve one more question. Says a company issued 20 million 4% convertible loan note at par on 4 January 2021. The loan notes are redeemable for cash or convertible into equity shares on the basis of 20 shares per 100 naira of debts at the option of the loan note holder on 31st December 2004. Similar but non-convertible loan notes carry an interest rate of 9% required.
Show how these loan notes should be accounted for in the financial statement at 31st December 2021. Okay. So here now, similar question, but the requirement is quite different here because they want us to prepare financial statement at the end of the year. So this guy also borrowed 20 million convertible loan notes. The nominal interest is 9%, market interest is 9%. The nominal interest is 4%, market interest rate is 9%. And they give us the conversion ratio. This conversion ratio, you don't need it. You see that I ignored it in the first question. Here too, you don't need it because you're not actually converting anything yet. So at the date you borrowed the money, you need to do a separation of this 20 million into debt and equity. So you determine the debt first by considering the interest per annum, which is 4% of 20 million, which is 800,000 every year. For 4 years, using a discount rate of 9% also, the annuity factor is 3.24, multiplied by 800 gives you 2.5. So at maturity, you also get the present value, not even at, yeah, you get the, we are considering this value at the date when you borrowed money. So you get the present value of the principal, which is this 20 million. You use the discount formula like I explained earlier. You get 0.708, multiply that by 20 million, it gives you this. The summation of the PV of interest and principal gives you this. So this 16.7 million represent the value of the financial liability. The equity component is the balance, which is 20 million. The money you borrowed minus the financial liability component gives you this. So what you're doing here is simply debiting bank with the money you borrowed, crediting the financial liability with that component, and crediting equity with this. That will be done at the date you borrow the money. Now, at the end of the year, the financial liability will be measured at amortized costs. I mean, you need to do this. This is the amortization schedule I taught you earlier. The value at the beginning is 16.7, like we got here. The interest payable, which is the effective interest or the market interest, is 9% on this, which gives us this. This is what goes to P&L, like I've explained to you before. The interest paid, which is the annual rate that you actually pay, is 4% on the principal, which is 20 million. That's 800. And this is the balance. My P&L, what goes to my finance cost, is that 1.5 million. And in my statement of financial position, the convertible loan notes will come up here as 17,459. And lest I forget, there will be equity component also that will just show under equity, which is 3,248,000 also. It will be there as equity. It could be you can just put it as equity reserve. It could just be there as equity reserve under my equity. So that's that for this question. And that's it for compound financial instruments. Is never more than this. And I need you to note something. Finance cost, dividend, and all of that. You see, for financial liability now, the interest that you pay on them goes to P&L for financial liability. But if it's equity, dividend does not go to P&L. It goes to statement of changes in equity as an appropriation of profits. It goes to your statement of changes in equity. But where I'm going is transaction cost. You see, when you borrow money, through debt, financial liability, you see, your transaction cost will usually be deducted from that money you have borrowed. It's deducted from the financial liability. But When you raise money through equity, the transaction cost is usually deducted from share premium. I just need you to note that transaction cost will usually be deducted from share premium.